use of leadership assessment in this space is the use of formal leadership assessment in this kind of private equity context seems like a relatively new evolution or new thing. Why, if you agree with that assumption, why do you think that is? What has held this space back in terms of really taking advantage of leadership assessment? Are there barriers to it, watch-outs for it? Just why isn't it a more popular or common kind of practice today, do you think?
Well, I think people are getting smart to it. I think the trend is accelerating and only going to accelerate. I think when you just look at, I was mentioning to Jeff earlier today, I was at a conference last week out in New York, and people talked about their biggest challenges of 2018 and their biggest future challenges of 2019 looking ahead, and both was talent. And it was all investors talking about portfolio companies. How do you attract talent? How do you make sure that talent stays? I mean, everything that's competitive in this environment. I think the barriers have oftentimes been maybe lack of knowledge. I think that knowledge of what assessment can do and what talent management can do, I think, is becoming more mainstream. You see more conferences about, human capital and operating partners and different things, because in this environment, people have got to figure out ways to justify paying the highest price for assets and being able to go in and create value. You can't just buy a business oftentimes and think you're not going to do anything with it and generate an acceptable return for your investors. So critical to everything people are trying to do from an execution standpoint is either augmenting the management team, figuring out different ways to use that talent, thinking about different strategies that the business maybe isn't executing today that you need new talent to bring. It's so critical. And I think that barrier is lack of knowledge, probably to an extent cost and time. But what I say to folks, and I'd say it in this room, I mean, the amount of money somebody pays for an assessment to bring in the right person or make sure you have the right person to increase EBITDA and then put a multiple on that EBITDA. If you do this the right way, the assessment and the time you spend, the return on that investment is so substantial. And to the flip of that is the risk that you put on the business by not assessing talent the right way or making bad hires puts you back oftentimes several years in your investment thesis and the strategy of what you're trying to execute.
I think the easiest answer for this is that private equity has changed a lot. Okay, so if you go back to the 80s and the early 90s, there was a lot less competition for deals, and you could put way more leverage on the deals than you can today. And as a result, I think it was a very transactional, much more transactional financial engineering business than it is today. Now there's so much money in the alternatives market chasing after deals that we know multiples have gone up. If you want to find something that's relatively cheap, it means that there's something wrong, and it usually gets fixed with people. Or, as Andy says, you want to augment the company by taking it in a new direction, which it's highly unlikely that the people who are there are going to be able to do that. So you're going to have to bring in, if you've got the right CEO, you're going to have to augment that person with new capabilities that come from people from the outside. And with the limited period of time that you're trying to make results happen in PE to get the rate of return that you want, you can't afford false starts. So you do want to be right the first time. And therefore, that's why I think assessment has grown. So I've often said that I think PE used to be about financial capital management. Now it's about two things: financial capital management and human capital management. And typically when PE organizations try to get deeper involved in a portfolio company and run it, it suggests that one of those two has gone awry. And those should be the areas of focus.
A couple thoughts on this topic. So one is in the context of a process where you have an investment banker involved and you're facing a tight timeline. So in that situation, it's very difficult on the front end before you're thinking about putting in a bid or a final bid to ultimately do the assessment that you want to do, which I think is really a flaw in where private equity has gone, because you just don't know. You maybe have a management meeting, you maybe have a dinner, you maybe get some time with management for a couple hours outside of that process. But it's really, really hard to make that assessment. So what we've tried to do in situations like that and make it pre-LOI or right after the LOI in a subject to close is to have somebody come down and basically do that assessment with the full management team for a day. We need to carve it out and feel like it's so critical to our diligence process that we are not going to stroke the check to make the investment unless we have had that full assessment that's done, typically on site, because you do surface a lot of issues. You do find some real talent in the organization too that maybe you're not thinking about. There's a lot of things that come out of those conversations. And then you really set the stage for what you need to do in the first 100 days to do more of the additional work. I think a better and more robust process is doing something similar to that, but around each area of the investment thesis, having a specific plan on what person in the organization is going to execute those specific tasks, and if you have the talent in the organization at close to make that happen. Because if you don't, what we absolutely need to be assured of is we can attract that talent to that situation to make the thesis happen. Because if you don't have the people to execute the thesis doesn't matter. Ultimately, it sounds cliche, but it really does all come down to the people. Where we have oftentimes seen assessment be even more important is when we get into situations where you have a founder that's going to transition over time, because hiring that number 2 person into an organization, to me, is the highest beta hire that you have, especially if that founder's still going to be around, even if they're not going to be around. And that's an area where I think spending additional time with that founder on the front end to make sure there is going to be very, very good chemistry. If you're thinking about replacing the CEO of the business as part of the investment, you've got to have a very detailed and thoughtful plan, not only plan A, but plan B and plan C if it doesn't work, because that's a big leap that I think people overestimate. Everyone gets excited with, hey, family-owned business, we can be a PE firm that come in here and do these things. It's always easier said than done.
We're talking about bringing in a third party, or at least, if not the party, the extra set of data points into this deal conversation. How do you do that? How do you convince people to pay attention to a set of data that they might not have considered before, or considered all that important before? How do you get them to pay attention? What kinds of things get in the way, and how do you get the organization to pay attention to this kind of insight?
It's interesting. Usually the first conversation is the most difficult, but then their eyes get opened and they love it. And it gives, we often find that it gives management teams an opportunity to maybe say some things or open up some topics that they otherwise couldn't talk to the investors or the board about, which is really interesting. So I think it initially starts with, you got to start at the top with the CEO and have it be the CEO's idea. If it's not the CEO's idea, it's not going to work. So it's convincing them that, hey, look, this is the best formula for just getting the right talent in the business to help everybody succeed. And that's the beauty, as everybody in this room knows about private equity, is you set up investments and co-investments and option programs so people's incentives are aligned, or you want them to be aligned. So usually you can make some alignment there that we are doing what's in the best interest of the business. And if you're doing what's in the best interest of the business, this assessment of talent is a step in that process. And then once they see it, my experience has been almost 100% of the time, they want to see more.
Need help achieving high-performance leadership? Let's begin a conversation.